On behalf of Crosscheck Media and Biz Talk Today TV, welcome everyone to the Money Path. I am your host, Todd Schoenberger. Joining me today for the first time is Andrew Clinton. He is the CEO of Stamford, Connecticut-based Clinton Investment Management. Andrew, welcome to the Money Path. You are a fixed income specialist. I need to ask the one question that I think all of Wall Street wants to know is that are investors finally believing the idea that rates are going to remain higher for longer?
Very timely question. Thank you for giving us the opportunity to be with you today, Todd. We were just joking earlier that, interest rates are rarely top of mind until they're top of mind, right? And that's one of the moments that we're in right now. Higher interest rates, I think, understandably concern investors of all kinds, whether you're borrowing for a home or a car or for plant and equipment. The interest rate obviously has a dramatic impact on you. And so from that perspective, in terms of the clarity and direction of rates, certainly within the last 8 weeks, interest rates have been on an upward trend. But as we've been saying as investors in the fixed income space, that's both opportunity and risk, right? The risk associated with the environment that we're in right now is that continuing rising interest rates are just more costly for the broader economy and can have a very significant dampening effect on economic activity were they to continue to move higher. On the other side of the coin, we have to think about what exactly is the reason why rates are moving up. And what we know is, and with a high degree of confidence, is this recent move up in interest rates is highly correlated to the move up in energy prices because of the conflict in the Middle East. And the real question becomes whether we believe that that's going to be sustained. And if you believe that the war is going to continue into perpetuity, then there is a meaningful risk of higher interest rates going forward. However, if you're of our opinion, and that is that this war, as maybe in many folks' view, is untimely and certainly unwelcome, the reality is it's also likely to be temporary, as will this movement up in interest rates, which creates, in our view, a significant opportunity because we don't believe that high rates will be sustained over the long term, as long as we do see a cessation in the conflict at some point.
And that opportunity, does that make now being one of the best opportunities to be in the municipal bond market?
Another really important question, and excuse me for talking our book, but the easy answer is it's certainly one of the best we've seen in recent memory. And we can put it in real terms for you and for your viewers. Today, you're looking at yields that are approaching, call it 4.5% on a tax-free basis for municipal bonds. For investors in the highest tax bracket, that equates to a taxable equivalent return of anywhere between 7.5% to 8%.
Wow.
And these are very high quality investments with very low default experience. On a relative basis, there's very few places you can go out there right now and get a similar return with low risk.
How important is the Fed in this? Because we've been obviously a change in leadership with the Fed. I get the idea. I mean, from a monetary policy standpoint, hiking rates, lowering rates, it all makes a lot of sense. But from a municipal bond standpoint, I mean, you have this idea, for example, in New York. I mean, you're in Connecticut. So in New York, you have so many people that have left. You have high wage earners that are leaving the state. That does impact tax rolls. What kind of an impact will we see, say, in the state of New York down the line if the tax rolls do not continue to inflate? Because I would imagine from a rating scale, that could have a damaging impact on all municipals in the state.
Well, it's important to remember, again, from the context of municipalities, municipalities by definition are semi-sovereigns, right? They're effectively delivering essential services to us all, and they have a moral and I would say a formal obligation to continue to provide those services. So even in an environment of increasing payrolls, as you mentioned, or tax collections, or environments of decreasing payrolls or tax collections, you have the same mandate. Ultimately, municipalities also have what we would argue are some really powerful tools to create revenue. And we're seeing this play out across the country right now in states like California and Washington, Rhode Island, and Massachusetts a few years ago. Virginia and others are now starting to, and Maine for that matter, are now starting to seriously consider the possibility of raising taxes to a significant degree and largely on the very wealthy. And so from that perspective, I think around your question around underlying credit quality, The municipalities have themselves the tools to create the revenue needed to offset any kind of decline in potential tax collections through higher revenues. The challenge, of course, is for the wealthy, there are going to be fewer and fewer places they can go to achieve very attractive returns on an after-tax basis. So the protection of your income and your assets from these higher tax rates will become ever more apparent as time goes on.
So, and we'll get into the opportunity side of it, but how important is it for, say, your clients? Are they, I mean, everybody loves the tax-free yield, like the tax-free income, especially off of those municipals, but, being triple tax-free. But is that really the biggest part of this, or is it now because there is an opportunity here to invest in the muni market and possibly actually see a return on that investment along with the yield, the coupons that you're getting? I mean, is that more important, the rate of return, or is it strictly just specifically with the tax-free income?
It's an important question you ask, largely because depending on different interest rate environments, my response to that question would be different. For example, during the 2021 and prior period where interest rates were very low, the majority of the return opportunity was really on the total return side, not on the tax-free income side. This environment is very different because we're starting at very high, we would argue, at least on a historical basis, very meaningfully higher interest rates. The majority of the return that most investors are going to be getting is going to be from income. We say all the time that munis are one of the few asset classes that in a rising tax regime, the return actually increases to the client because the actual return we're delivering is tax-free. So if taxes are going up on everything else, then the actual return on our investment actually on a tax adjusted basis is also going up. There's few other asset classes where that actually occurs. So from that perspective, there's layers of opportunity in our marketplace. Number one is the yield, which we talked about, which is approaching 8%, which is very compelling in and of itself. But let's imagine a scenario where that, I don't know whether it's tomorrow, 3 weeks from now, 3 months from now, but let's say that there's a solution that's arrived at where the Strait of Hormuz reopens and the conflict dissipates over time. The likelihood is that interest rates will fall back to a level that they need to be at to support an economy that is still dealing with the challenges of a weaker labor force, which these are the things that the Federal Reserve and the Powell himself was talking about prior to the onset of the conflict. We were looking at an environment where labor force and job creation was weak and continues to be relatively anemic. And so in that scenario, the Fed's dual mandate of trying to keep inflation low, but also keep job environment healthy, there's a tension there. And that tension is requiring the Fed to really focus on what is the greatest risk, which understandably the concern around the movement up of headline inflation, which is due to energy prices and food, but core inflation has still been relatively modest, which has been really positive. So again, that's why those two components exist. But from the perspective of the opportunity set greatest, let's imagine a scenario where interest rates fall by 50 basis points. Just 50 basis points. So which means that they wouldn't even go back to where they were just 8 weeks ago, that they're still above where they were 8 weeks ago. A 50 basis point movement on a bond that's roughly a 10 duration means a 5% total return in terms of
Wow.
principal return on top of the income you're getting. So if rates drop by 50 basis points over 12 months and you're getting a taxable return, call it 8% to keep the math simple, that's 13 percentage points of total return that a client perceivably could receive. So there is a significant opportunity for both, I would say, in the current environment.
So are you looking at, when you're laddering and you're looking at a portfolio of any type of fixed income instrument, is your focus, are you looking more shorter term, or are you thinking maybe we should look longer out on the curve?
Yeah, I would distinguish our firm and our strategies a little differently. We do not ladder portfolios at
Okay.
all. Laddering, by definition, for those who may not know, is taking an equal percentage allocation of a specific security on every spot in the yield curve, meaning that you'd have 10% in 1 year, 10% in 2 years, all the way out to, let's say, 10 years. That's a traditional ladder portfolio.
Mhm.
We believe there's greater opportunity in being more selective about the maturities that are likely to outperform based on our own internal proprietary analysis around where the best spots on the yield curve are. And we don't see them as being in the, call it the 5 to 10 year area of the curve right now. We see them as being further out the yield curve. And so, yeah, please.
Well, I was going to ask, so then, and that makes sense because you're not passive. You are an active investment manager here. So when, and you're an expert, you're a subject matter expert, your firm specializes in the fixed income area. How important is active management when it comes to building or creating or crafting that portfolio of fixed income instruments?
Yeah, active management adds a lot of value. It empirically has been shown to be the case over time, where you'll notice if you look at municipal active managers, and we're not the only ones who outperform peers and benchmarks, it's very different than in, let's say, the equity universe, where a few managers outperform the S&P 500. There are opportunities because of the inefficiencies in our marketplace to add a lot of value. That is in many different forms. It could be just in our view of the macro environment and where those opportunities might be along the yield curve. It could be in the form of where the sector opportunities are, that there's various different sectors and segments of the municipal fixed income space that are revenue backed or geo backed, that is property tax backed. It could also be under the underlying credits themselves. And so the tendency is in the municipal fixed income and all of fixed income space to move and gravitate toward the highest quality bonds. And we would argue if you look in the municipal bond market, it's one of those few areas of fixed income where the default differential between AAA rated bonds and the lowest rung of investment grade, which is BAA rated securities, or triple B if you're looking at S&P, are roughly the same. They default almost never. And so the yield differential between AAAs and BAAs right now is attractive in our view, which is why we incorporate them in client portfolios, because it adds additional income. So that's the credit selection component where an active manager can add value as well.
And that sounds great because from an investor standpoint, you're mitigating risk. So how important is that? Because if you're a passive, say, muni ETF manager, I mean, are they assuming more risk that investors probably don't understand?
It's an interesting question. I would say my response to that question would be there are very different types of clients that are appropriate for different types of strategies. So for somebody who's looking to simply express an exposure to the municipal bond market on a short-term basis, perhaps the ETF strategy could be an appropriate solution. For investors who are looking to maximize yield and total return over time, because of the opportunistic nature of active management versus passive management, historically adding value, then maybe not that may not be an optimal strategy for that client. So what I would say is that from our client's perspective, we're looking to provide services that maximize yield and deliver maximum total return over time, and we've been able to do that successfully. And so it really is also incumbent to understand an investor's not only their investment objectives, but their time horizon. Somebody who wants to just be in munis one day and sell it the next, certainly an ETF strategy could be appropriate. But for somebody who's looking to maximize value over the long term, 3 to 5 years, if not longer, a professional manager can be a better solution.
Let's turn the page to politics real quick. We are in a midterm election year. I'm just want to get your thoughts on the with the current political environment, but also upcoming policy changes. Do you see significant demand changes when it comes to, say, the municipal market?
So we're already starting to see this, and I alluded to it earlier. And again, using our strategies as a microcosm of what's happening in the marketplace, we've just experienced the largest inflows into our strategies on a consecutive basis over the last few months that we've ever seen in our firm's history.
Wow. Congrats.
Thank you. That's due in large part to not only the nature of the differentiated nature of what we do and the value we deliver, but it's also an expression of what clients are starting to see. The better portion of 2025 was a lot of uncertainty around tariffs and how they were going to create revenue and whether municipal tax exempt income might be also subject to that revenue creation. That turned out not to be the case. And munis actually delivered very solid returns by the end of the year last year, which was not expected at the beginning of the year, but perhaps by very few outside of ourselves. So now clients are starting to see the prospect for this going forward is saying, look, on a risk adjusted basis, I can get an equity-like return or even a private credit-like return in municipal fixed income today without having to take any of the private credit exposures, i.e. lockups and gates and high performance fees and debt that becomes equity because of perhaps some of those loan challenges that they're running into at the moment. So we're not subject to the same kind of changes, but actually deliver the same type of return. And that's something that's really compelling to folks right now, and understandably so. And we see that certainly this most recent drift higher in yields and interest rates as just like the icing on the cake, right? In terms of providing even more compelling reason for clients to reconsider where they're best allocated.
So, Andrew, what policy changes do you think could actually impact volatility in the fixed income market, say over the next 12 months?
So clearly, a discussion about what's likely to happen in the upcoming midterms is top of mind. You're starting to see the headlines in the news. Folks are already starting to think about going to the polls and who they might be voting for. And what we would say is that the likelihood, and we're reading the polls as everyone else is, it seems to us that, as it has been the case in every other midterm election, anytime you've had a dominance of a particular party in both the House, the Senate, and the president's office, what you end up seeing is you see a shift ultimately to the other party, meaning you end up with divided government. That seems likely again this time. It looks like there's a probability that the Democrats will take control of the House, at least the House yet again, which again, divided government as it relates to the broader economic and political spectrum is not the end of the world. And quite frankly, as it relates to fixed income in particular, it tends to be very positive. High quality assets in an environment where nothing really changes, for better or for worse, ends up being constructive for the outlook for fixed income. And so that is our view as well. As it relates to municipal policy in particular, we continue to believe that as the economy moderates and there won't be sufficient, or maybe let's say more significant support from a fiscal stimulus perspective, i.e. additional monies being afforded to the states as this environment of economic growth moderates, that means they're going to have to likely tighten their belts to a degree. You saw this in California when they approved their budget more recently, and they actually had to borrow from or take some money from the rainy day funds. This is what happens when tax receipts fall. And so from that perspective, it's not the end of the world. It just means that state and local governments have to balance their liabilities with their revenues. And the likelihood is that if they don't want to reduce spending because they have an at-need population that is still in need of those services, they're going to have to raise taxes. So as that will, again, very long response to your question, I apologize, but as that will impact the muni market, it'll actually create more demand for the tax-free income and that munis provide for those in-state residents. And so we see that the technicals are very favorable.
Well, you have no need to apologize. It's a brilliant answer. I know the audience gets a lot out of that knowledge. And we don't have fixed income specialists because on BTT a lot because there's not many of you out there. So I appreciate you doing what you're doing today. So tell us about Clinton Investment Management. I mean, you're specialized in the fixed income area. This is your corner. You're cornering the market. I mean, tell everyone, introduce the firm to the audience.
Yeah, sure. Thank you for that opportunity. Clinton Investment Management. I didn't get creative with the name when I founded the firm back in 2007. We're maybe not quite 20 years in the business, so it's starting to feel like I've been doing this for a while. Prior to that, I was at UBS Global Asset Management for 14 years, so I've been in the business for over 30 years. Always specializing in municipal fixed income. It is a unique marketplace that has extraordinary inefficiencies because of the nature of the different types of constituents and investors that participate, from retail, trust-directed, broker-directed, property and casualty companies, sophisticated institutional investors, mutual fund investors. Because all those customers are not always doing the same thing at the same time, it creates relative value that we as a professional manager can identify and then take advantage of for our clients. So the primary, I would say, differentiation of our firm relative to other firms, that we manage a little over $4 billion in client assets across our strategies. So from small investors to large family offices. But why clients come to us is because, as I mentioned earlier, we take a different approach and perspective on the muni market. We recognize that, one of the questions that comes up often is, well, are munis cheap or rich relative to treasuries, right? And that's a common theme. The ratio of the yield of a muni to a treasury is a relative value term that's used a lot. We often argue that it's misunderstood because it's an unfair comparison in the sense that your choice isn't just to own AAA rated munis or AAA rated treasuries. On that basis, yes, munis can be cheap or rich on that evaluation. But if you look at the lower quality or lower rated, I would argue, munis, AA, single A, and BAA rated securities that default at roughly the same rate as AAA rated securities, which is never, the yield differential on AA, single A, and BAA rated munis is still substantially more than taxable treasuries, almost always. And so on that basis, folks that are in the highest tax bracket are in almost every scenario better off being in tax-free munis than taxable treasuries. And so that's our value proposition that we bring, is because we're a manager that focuses on credit, and we're able to deliver higher returns over time by virtue of not simply being confined to the highest quality AA or AAAs, because we have a history of investing in munis. And I would make the statement that if you look at the history of the muni market where default rates are low, for our clients, default rates are zero. We've never had a default in the over, you call it almost 20 years we've been managing money as a firm, and the over 30 years I've been managing money as a PM.
That's impressive. That's quite impressive. So if a family office, a new investor, they go to you, and what's the one biggest mistake that you've seen? Give us a case study here where you actually have seen when it comes to fixed income investing.
Yeah, I think when it comes to munis, there's an oversimplification of the marketplace, right? There's a tendency to focus on yield and maturity and nothing else, right? That somebody says, okay, I'm going to give you my money. How much yield am I getting and when do I get my money back? Thinking of it almost like a tax exempt CD. And the reality is the value of the municipal securities fluctuate over time. There's times when you want to be a buyer of securities. There's times when you want to be a seller of securities. Some bonds get rich and cheap, just like a stock would. And yet the perception is for investors in the muni market is that they're always fairly valued. And that's simply not true. And so that's where a professional manager has the opportunity to say, hey, look, I know where that bond should be trading. It's not trading there right now. Is that an opportunity or is that a risk? And so that's a common misconception that investors make, and we see it often. And so there's a tendency for investors to invest in only the highest quality bonds, as I mentioned, because the perception is, well, I'm actually not taking more risk. I'm taking less risk, and that's true. But here's an interesting data point. Most investors would have no problems investing in a AAA rated corporate. What's the actual AAA rated corporate default rate according to Moody's over the last 50 plus years? It's 0.3%. So all AAA rated corporates ever rated by munis have defaulted almost never. Well, what's the single A rated default rate of munis? It's 0.1%, meaning that it's actually a lower default rate than AAA rated corporates. Yet how many investors in munis actually own a significant allocation in single A rated munis? I would argue it's very, very few. And so that's the opportunity set that we bring, an understanding and a depth of research in the marketplace that brings real value to clients that they wouldn't be able to get on their own or through a passive strategy elsewhere.
That's interesting. Just curious, does Clinton Investment Management also work with other forms of fixed income, say in the commercial paper space?
So we don't have commercial paper offerings per se. We offer a taxable fixed income strategy whereby we take advantage of the relationship of taxable munis relative to taxable corporates. The reason why that's an interesting strategy in our view and needs and warranting further consideration by investors, because what you end up finding is what I just said, which is that munis default at a lower frequency than corporates, and yet taxable munis trade at higher yields at the same ratings level, which should not be the case. Munis should, in theory, because they're lower risk, trade at lower yields than corporates at the same ratings, and they don't. And so that's the inefficiency that taxable strategy takes advantage of, and one that we're looking to continue to do so on a going forward basis.
Yeah, when I was a trader at Lake Mason in Washington, I used to specialize in commercial paper. I would always look for the lower rated ones, like A2, P2 paper for the corporate clients. And anyway,
Well,
but
that's
I don't
that's
know.
it's an interesting point you make, and I'll just digress real quickly on that. So
Please.
it sort of gets into the assessment of credit quality. If you understand the underlying credit quality, the idea is that you should go to the lowest possible rung of the actual capital structure because you're confident in the underlying credit, and so therefore that's where the return is greatest. But the tendency is for investors to do just the opposite, again, which is where the opportunity set continues to expand.
Yeah, no, I completely agree with that statement. Final question for you, and this is just from the business side of it. Do you prefer a bear market in equities, or does it just not matter?
We often say that equities and munis are natural complements of one another. Environments like this one are unique in the sense that if you look at the historical return of the S&P 500 over the last 15 years, it's
Hmm.
been positive, roughly 15% returns annually, not every year, but annually over that time frame on a inflation adjusted basis, which is incredible, right? It's like nothing that we've seen in recent memory by any measure. The question and challenge for investors today is the absolute valuations on equities, where they are right now, in terms of the PE ratio in particular on the S&P, for example, is among the highest ever in history. So the starting point, we often say, matters. When you're getting into the market, it matters. So if you look at, again, students of history, any other time we've been at these valuations of the S&P 500 or higher, the average annual 10-year return of the S&P, maybe you know this number, is a +2 to -2% annually, right? And we're
Hmm.
delivering in the muni market today a 7 to 8% return. So we're not necessarily saying that equities are going to crash or move up dramatically. All we're saying is that munis today offer you an equity-like return without equity-like risk, which is a rare moment and window of opportunity we think clients are maybe not paying enough attention to and should.
That's brilliant. I love it. You know your stuff, that's for sure, Andrew. Definitely are an expert. So I appreciate you so much for joining me today. I know the audience is just going to get a ton of value out of watching you and hearing your thoughts, but I do hope to have you back sometime in the near future.
Enjoying being with you. Thanks, Todd.
Absolutely. So, on behalf of Andrew Clinton from Clinton Investment Management, go check it out, everyone. I am Todd Schoenberger. Thank you once again for joining us on the Money Path. Coming up at 2 o'clock live, I have a sit down with Rob Thummel. He's going to tell you all about the energy trade. You will not want to miss what he has to say. That's at 2 o'clock. Until then, take care.
Access real-time data and intelligent analytics exactly when you need them. Get the right data at the right time. Learn more at quotemedia.com.